Assalamualaikum warahmatullahi wabarakatuh. My name is Nurizana Izura binti Rohizat. So I was assigned by our lecturer, Madam Atika, to talk about the risk management from Islamic viewpoint. So first of all, I will start with the introduction about what is risk. So risk is basically uncertainty about the future outcome of an event, and also risk traditionally means possibility of harm, injury and also loss. But risk from an Islamic perspective and its management are embodied in the overall goals of Islamic law or Maqasid al-Sharia. Al-Ghazali defines Maqasid as promotion of well-being of the people, which lies in safeguarding their faith, self, intellect, posterity and also wealth. While risks are not desirable on their own, they must be undertaken to create wealth and value. From an Islamic perspective, economic activities are not judged by their inherent risks, but whether they add value and or create wealth. So, risk management from Islamic viewpoint, Hassan 2009 identifies three types of risk from the Islamic perspective. The firstly is essential risk, whereby that is inherent in all business transactions. This risk is necessarily and must be undertaken to reap the associated reward or profit. There's two legal maxims associated returns to essential risks, which are the first one is the detriment is as a return for the benefit. This maxim attached the entitlement of gain to the responsibility of loss, and the second maxim is benefit of a thing is a return for the liability for loss from that thing. The maxim asserts that the party enjoying the full benefits of an asset or object should bear the risk of ownership. And the second risk is prohibited risk. Prohibited risk in the form of excessive gara. Generally, gara relates to the ambiguity and or ignorance for either the terms of the contract or in the object of the contract. Thus, sale can be void due to gara. Due to risk of existence and taking possession of the object of sale on one hand, and uncertainty of the quantity, quality, price and time of payment on the other. And the last risk is a permissible risk. Permissible risk is a necessary and cannot be avoided in order to gain profit. An example of the risk can be operation risk, liquidity risk and etc. This risk can be either be accepted or avoided. So, in the history of Islam, there are many incidents that are closely related, which can be used as a benchmark. In facing and managing risk, several steps can be implemented, which are risk avoiding, risk reduction, risk sharing, and risk controlling. And I will touch about the approaches in risk sharing. So, risk sharing approach is a common practice in Islamic banking or financing. Therefore, risk sharing should be in line with the risk management principle which have been set by Islamic Financial Services Board. The principles provide a set of guidelines of best practice for establishing and implementing effective risk management in financial institutions that offer services in accordance to Sharia rules and principles. So, the principle provides specific assistance for each type of risk. So, there's a 6 type risk, which are the first one is credit risk. The credit risk is arising in Islamic banking when the bank pays money under salam or istisna contract and deliver goods under the murabaha contract before receiving its own asset or money. And the second is investment risk. Investment risk is the risk arising from entering into a partnership for the purpose of undertaking or participating in a particular financing or general business activity as described in the contract, and in which the provider of financial in the business risk. And the third is market risk. Market risk is defined as any risk that could incur losses in financial institution due to market price movement, which is commonly caused by changes in the price of equity instrument and trade activities, currency, quasi-fixed income security and also commodities. And the fourth is liquidity risk. Liquidity risk for banks arises from a mismatch between the demand for a supply of funds. The supply of funds comes from the customer deposit, repayments of credit facilities, borrowing from financial markets, interest and non-interest income, and sale of banks' assets. And the fifth risk is rate of return. Rate of return arises because of unexpected changes in the market rate of return, which adversely affect the firm's earnings. And the last risk is operational risk. Operational risk is a loss or hazard event incurred due to internal and external events associated with bank's operations. So these principles are grouped into 6 categories of risk and shall be used as the basis for IFI bank management process. So I think that's all from me. Thank you so much and Assalamualaikum.